Hey. Good morning, everybody. Lee Lowell here, smartoptionseller.com. How's everyone doing today? It is Saturday, September 5th, 2020. Hey, we got some good options information for you today. We will be covering the poor man's covered call, that strategy. Don't know what the poor man's covered call is? You got to stick around and we'll talk about that in a little bit. But first, let's get to our Saturday synopsis. I like to take a look at the chart, see what the market's done over the last week, and see what it may be expected for the week ahead. So let's dive right in. Always look at the SPY, which is the exchange traded fund for the S&P 500. Now, if you follow the markets, you would have seen the crazy week we had. Started out the week, Monday, Tuesday, Wednesday, making all-time new highs again, right here on Wednesday. Then Thursday and Friday, boom, we had a huge sell-off Thursday and Friday. And there's an old axiom in Wall Street saying that stocks take the stairs up and the elevator down. And that's how it happens when you get these unabated up moves. At some point, you're going to get a very violent down move because you're going to get a lot of profit taking and you're going to reach unsustainable heights. And then we get these big moves down. And that happens, that repeats all the time. Stocks take the stairs up, boom, elevator down. So it happens from time to time. It's healthy, it's needed, it's good. Get the froth out of the market, shake the weak hands out of the market. So in the SPY, we had this long-term resistance right here. Here is the all-time high back in February before the coronavirus. Blasted through that over the last 2 weeks, which we had talked about. Made all-time new highs on Friday, and then boom, we had the big move down. Now, what markets will tend to do is that they will try to revert back to support areas or moving average lines. You can see we've got the 20-day moving average line right here, and the SPY, the S&P 500 index, had been sort of hugging this line for a long time. And then on Thursday, the low of the day came right on the 20-day moving average. Friday, we blasted through that, but came back up to end the day right on the 20-day moving average, right around 342.57. So that's how markets work. They like to move back to very comfortable areas that they know. And in this case, this is a 20-day moving average. So that's where the S&P 500 finished on Friday. Let's take a look at the NASDAQ, which had been the strongest of the three main indexes. Same thing. Stairs up, elevator down, big moves down Thursday and Friday. Thursday, it finished right, it closed, I should say the low was right on the 20-day moving average. You can see here's Thursday's action, this bar right here. And then on Friday, it went down just about to tag the 50-day moving average, which is this line right here. So it works almost to perfection. The market looks for certain levels. 20-day and 50-day moving averages are widely followed levels. So Thursday, it hit the 20-day, and then on Friday, it just about tagged the 50-day. And then it closed just underneath the 20-day moving average on Friday. So got a lot of the froth taken out. That's a good thing. You want to get back on more solid footing. What do I see for next week? Well, if the 50-day moving average can hold, and this is where it closed up here. So if we open up on Tuesday, U.S. markets are closed on Monday. So Tuesday, we'll see. It may meander around. After big moves like this, the market needs to digest it. So it's not going to go all the way back up that quickly. And I can't see it really wanting to go through the 50-day moving average just yet. I mean, it's going to digest the move, so it probably meander a little bit. And if it can get its footing again, it'll probably start ticking up on its way back up. News around the coronavirus is that, we've got vaccines. A lot of them are in these phase 3 trials now. So a vaccine is coming, which is good news. Unemployment here in the U.S. was ticking down. The report came out yesterday, which is also good news. And of course, we have governments around the world still backstopping everything. So I can't see this bull move all of a sudden turn into another bear move, okay? So the 50-day moving average, look for that as being the support. Close right here. So could meander around or go higher. Let's take a look at the Dow Industrials, which had been the laggard of the three. Still hasn't taken out its all-time highs yet. It's getting close. Last week, I had drawn this bull flag, right? We talked about the bull flag, which is a bullish pattern. And of course, the market moved out and up out of the bull flag, which we thought it would. Right here, getting very close to its all-time new highs. And then, of course, Thursday and Friday, it had a down move. And once again, the 20-day moving average That's where it settled on Friday. So you have to look at these moving averages as magnets, as you know, and as lines of support on the down move. So we got the 20-day moving average. That's where the Dow closed on Friday. Same thing. 50-day moving averages down here. That should act as a support level if it does sell off again. But these big moves have to be digested. Let everyone take it in. So it could meander a little bit, and then hopefully it could go back on its upward trajectory. One thing of note, let's take a look at the VIX real quick and see what was happening there. It was very telling at the beginning of this week and the end of last week. The VIX started to go up. Now, we've always talked about the VIX, which is the fear indicator, and it tells us how expensive or not option prices are in regard to the past. Now, typically, the VIX will move in opposite direction to the general market. Now, back in February, March, when the market was selling off, the VIX went up. That means volatility was going up. People were panicking. Option prices were getting more expensive. And then when the market started to rebound, the VIX started to come off again. So what I want to do is overlay the VIX onto the SPY, because the VIX is calculated off of S&P 500 options. So let's do a little thing here. Let's put the VIX on the chart so we can see both at the same time. Okay, so now we've got the VIX. Here's the VIX down here, and here's the S&P 500 up here. So as you can see right here, we started to get a little up move in the VIX, which portends to this move right here. So the market was moving up and the VIX was moving up at the same time. So that was a little bit of an advance warning that people were starting to get a little nervous that the market was getting toppy right around here. So as the market was moving up, the VIX was also moving higher. So that was a little bit of a telling sign that, hey, we may be getting a down move in the market pretty soon. And that's exactly what happened. We had the big move Thursday and Friday down and the up move in the VIX. So let's see what plays out over the week. Like I said, the market has reverted back to the moving average lines. Probably will meander around. The VIX will probably meander around as well. The VIX closed at 30.75 on Friday. That's right around here. And so that'll probably meander as well. It's good. The VIX moves off of whatever the market does. So if the market starts to go back up, the VIX will start to come back down. So that is the assessment of the broader index. Let's take a look at some of the individual charts. Now, let me remove, let me take this off here. Take off the VIX. We got the SPY nice all by itself. So the NASDAQ, of course, saw the biggest brunt of the down move, and some of the individual stocks in the NASDAQ got hurt as well. And we're talking about the biggies. We've got Facebook and Amazon and Google and Netflix and Apple. Let's take a look at some of these charts, see what happened. Let's specifically take a look at Apple, because that's everyone's favorite. Everybody loves Apple. Apple had a massive down move, made the highs, new all-time highs on Wednesday up here. Thursday and Friday just got nailed. And look where it finished right on Friday, right on the 20-day moving average. Very important, people. You have to follow these moving averages. I use a 20-day, 50-day, 200-day moving average. These stock, everyone's using the same thing, so it's sort of a self-fulfilling prophecy. Apple finished right on the 20-day moving average, just under $121 a share. So it had a good down move, almost tagged 110, it's close to 140. So that's a pretty sharp move for Apple. It's almost a $30 move. That's post-split. If it was still before the split, that would be about a $120 move from top to bottom. Now, it's a big move for Apple. So you've got, some people want to get back in. From here, people are missing the move, getting that FOMO, fear of missing out. And then we've got this big down move. So you might see the pent-up buyers who've been wanting to get in on Apple. So hopefully we see the market go back up over time. Let's take a look at Amazon, see what happened there. Big hit. So these frothy stocks just took a nice big beating Thursday and Friday. Once again, look where Amazon finished on Friday, right at the 20-day moving average. These things are like magnets, people. Let's take a look at Google. Google, big hit. Let's see, did it finish on, it closed at 1581 right here. So, yep, right on the 20-day moving average. That's where it's settling. Let's see what Microsoft is doing. These are the biggies. These are the biggies, big names. These are the stocks that have been driving the indexes higher over the course of the last few months. Microsoft took a big hit, tagged all-time new highs around 233 or so, dropped down to about 205, and then rallied back up to the end of the day, right near the moving average, the 20-day moving average. Facebook came down as well, had been driving higher, dropped lows, went past the 20-day moving average, finished above the 20-day moving average. So that's a good thing for Facebook. And lastly, we take a look at Tesla, because Tesla has been just phenomenal. Look at this massive move up. And then Tesla had a pretty good hit. Finished. Let's see where it finished on Friday. Finished up here around 418. So it's above the 20-day moving average, but didn't want to venture too far down below the 20-day moving average. So pop back up. Netflix is another biggie as well. Netflix had a pretty sizable down move the last couple days. Finished above the 20-day and 50-day moving averages, so that's good. This move in Netflix these last few days, it's not as big as the move from here to here. So Netflix didn't move as far. So Netflix is still a very strong stock. Let's hope. And the moving averages are still sloping upwards. That's what you want to see. You want to see the moving averages sloping upwards, all sloping upwards. So those are good, still bullish momentum stocks. So even though we've had some froth taken out, that's healthy for the market. So let's just hope that the market keeps ticking up after we digest these moves. So that's it for what I see in the market. We had a big move. Some froth had to be taken out. That's okay. That's fine. And I have a feeling that the market will find its footing again and continue on higher over the ensuing weeks. Now, let's talk about the options trading strategy of the day, which is called the poor man's covered call. Why is it called the poor man's covered call? Because it takes less money to get into the trade. The less money you have, the easier it is to do the poor man's covered call. But number one, let's talk about what is a covered call. Covered call is a way for you to take in some income that you have against shares of stock in your account. Now, if you have at least 100 shares of stock in your account, you can execute what's called a covered call transaction. And what that is that you have 100 shares of stock in your account and you sell a covered call to somebody else. You take an income, and what you're doing is obligating yourself to sell your shares to somebody else at a higher price at some point in the future. So if you have a stock and you're looking to possibly take profits on that stock sometime in the future, you can sell a covered call. And if the stock doesn't reach the strike price of that call option, the option expires and your obligation disappears. So you can roll these covered calls throughout the year, taking in extra income while still holding onto your shares of stock. So it's a way of making passive income. It's called a passive income strategy. So let's look at an example of what you can do with a regular covered call, and then what you can do with a poor man's covered call. Let's take a look at Apple, because we'll use that as our example here. Now, this is a chart of Apple. We looked at this before. Apple finished just under $121 a share. Okay, so if you have at least 100 shares of Apple, you can sell one call option contract, and that call option contract brings in money to your account. Bank that money, put in your account. Now you have the obligation to sell your shares of Apple at some point in the future at a higher price. And when you sell a covered call, you want to use strike prices above the current price of the stock. That's called selling an out-of-the-money covered call. You sell it at a strike price up here. So Apple has to go all the way up here if you ever have your shares called away from you. So let's take a look at an example. Move this up here. Let's take a look at my little cheat sheet here. Now we're going to talk about selling a covered call as the poor man's covered call. Now, in the poor man's covered call, what you do is you substitute buying 100 shares of stock, and you substitute it with buying a deep in the money call option instead. Now, I've made videos. I've talked about deep in the money call option buying strategies. That's my favorite option buying strategy. If I want to get long shares of stock instead, I will buy a deep in the money call option. And the reason why it's called the poor man's covered call is because the deep in the money call option costs you a lot less dollar-wise. So let's take a look at an example here. And this is an example only, not a live recommendation. If you bought 100 shares of Apple today at $120 a share, it would cost you $12,000. Now that's a pretty hefty penny. You know, a lot of people can't afford that. Their accounts are not that large. So shelling out $12,000 for 100 shares of Apple is a big deal. But what you can do instead, and you can buy a deep in the money call option that pretty much acts like the stock itself. Now, I've talked about buying deep in the money calls. The way you do that is you buy at least a 90 delta option. And a 90 delta option is synonymous with buying a deep in the money call. So in this case, I'm going to buy a September 2021 72.50 deep in the money call option for $52 per contract. And that is an outlay of $5,200. Now, this is why it's called the poor man's covered call, because the $5,200 is a lot less than $12,000. You've got a savings of $6,800, which is a 50% discount, and you have that much less money at risk. Instead of risking $12,000, you're only risking $5,200. So the poor man's covered call, you're using the deep in the money call option as a substitute instead of buying 100 shares of Apple. And here's how we're going to find that call option. Let's pull up our Interactive Brokers option chain here. There's option chain of Apple at Interactive Brokers, call options on the left, put options on the right. I've got my Apple tab opened up here. When you use Interactive Brokers as your broker, you can use these option chains and open up as many tabs as you want, pick a stock, and you can look at the option prices. Now, deep in the money call options. Now, we're talking about long-term investment in Apple. We're looking at a little over 1 year option on Apple. September 17th, 2021. We're looking at the deep in the money call options that have at least a 90% delta or very close to a 90% delta. In this case, we're looking at the 72.50 call option over here. Here's our delta, 0.899. So that's roughly a 90% delta. Here's the delta column. We want to choose options that have at least a 90% delta. And yesterday, Friday, went out bid ask 51.45 at 52.55. Let's give a fair value of $52 even per contract. Okay, so I'm sorry, the 72.5 call right here, $52 per contract. That's a $5,200 investment. So let's go back to our cheat sheet. We're going to buy one 72.50 call of the September 2021s. Costs $52 per contract. That's an outlay of $5,200. You always want to know what your break-even price is on that option. Figure out the break-even. You take your strike price, $72.50, and add the cost of that option, $52 a contract. That's a break-even of $124.50. Okay, with Apple at $120 a share, your break-even's $4.50 higher. So over the course of the next year, all Apple has to do is move $4.50 higher over the course of 1 year for you to break even. I think that's a very easy task to accomplish. I think Apple's going to go up more than $4.50 just to break even. Now, to invoke the covered call part of the strategy, what you do is you want to sell a call option against that position. So you can either call it a poor man's covered call, you can actually call it a call spread. You know, you're buying one call option and you're going to sell a different call option against it. So as our example, to bring in monthly income or bring in income of, you can choose any expiration you want. We're looking to sell monthly call options. You can sell in October 16th, 2020, 155 out of the money call option for $1.60 per contract. Now you notice the strike price, 155, is higher than the current price of Apple. That's called selling an out of the money call option. You want to choose strike prices that are higher than your break even, because there's no point of selling a covered call at a strike price lower than your break even. So the call option you choose out of the money has to be higher than at least your break even. Now, how do we find these? We go back to our Interactive Brokers option chain, look at the October 16, 2020 call options, scroll up. We want to choose the out of the money options. And here we go, the 155 call options right here. Let's wait till the prices start to populate. Okay, 155. a 153 bid at 171 offer. So $1.60 right in the middle. Always want to try to shoot for something right in between the bid ask. So we're going to sell that one call option, because if you buy one call option of the deep in the money, you can only sell one call option of the covered call. You have to do the same amounts of contracts. So you're going to sell one of the 155 calls for $1.60 per contract, and that equals, I didn't write this down, that equals $160 that gets deposited right into your account. And that gives you a little income to cover the cost of what you've paid out to buy the deep in the money call option. So now this acts as a way to reduce your break even. You got your $160 and you subtract it from your break even here, and now your new break even is $122.90, right? So Apple doesn't have to go very far in order for you to start breaking even. Now the thing about the covered calls is that your strike price on the covered call is $155, and Apple's currently at $120. So Apple has to travel $35 a share by October 16th, 2020, in order for your shares to get called away from you. So if you get the shares called away from you, that means you're selling your shares at $155. Now, what will that do for you? Well, if you get called out at $155, you're going to get capital appreciation on the deep in the money call option. Okay, so you sell them at $155. Your break even was $124.50. So you got a $3,000 profit on just holding that deep in the money call option. Plus you've got the $160 for the selling of the covered call. So your full net profit would be $3,210. That's if Apple rallies all the way up to $155 and you have to sell. You would have to. That's where your break even is, and so you would actually get short 100 shares of the stock, but you would still hold on to the deep in the money column. So that basically the trade is done. You're not going to make any more money on it because the short shares now are going to be offsetting any money you make on the call option. So at that point, the trade is pretty much a wash. So you take in your profit. You can sell out your covered. You can sell out the deep in the money call, and you can buy back the shares. You can always get out of the trade at any time you want, but in essence, you have to decide what level you want to sell the covered call for. Now, if you go back, let's take a look at Apple. Apple's at, closed at $120.96, but we're using $120 as our base. Apple would have to travel all the way up here to $155 a share by October 16th, which is right around here, okay, roughly. So do you think Apple's going to travel all the way back up there in the next 41 days or so? It's up to you to decide. And if it does, you have to get rid of your shares. Now, Apple could keep going up, and you'd still have to sell your shares at $155. So that's one thing you need to make sure you're okay with. You're okay with selling them potentially at that price. Now, if Apple doesn't go up to $155 by October, the option will expire. You keep the $160, and now your deep in the money call option is still intact. So now you could sell another covered call in November or December. You take a look at the option chains. Now, if we go out to November, if you wanted to sell a November option instead, you can do that. You can pick any of these months as your covered call transactions. If you wanted to sell, let's say, 170 call right here for $2.25 a contract. So you get more upside potential. You're selling a 170 call instead of the 155 call, and you're getting a little bit more money for them. The farther you go out in expiration, the more the option costs. So you can decide which strike to choose. And once and if the option expires worthless, your deep in the money call is still intact, and you can keep repeating the trade. So we've got our little cheat sheet here. So if you get called out, you're going to have that trade is all locked in. And then if you don't get called out, you can just repeat the process. So that's what's called the poor man's covered call. Once again, it's called poor man's because instead of buying shares of stock and paying out $12,000, you're buying a deep in the money call option with a 90% delta that acts just like the stock itself, but it only costs you $5,200. A lot less money at risk, a lot less money out of your wallet. So that's why it's called the poor man's covered call. So that's it for your lesson on the poor man's covered call and your Saturday synopsis. I hope everybody enjoy this video. If you liked it, give me a thumbs up. Send me a comment. I love hearing from you. Subscribe to the YouTube channel. And that's it. Once again, you can always go to our website, download our free Put Selling Basics guide if you haven't done it already. And I hope everyone has a great weekend and a great trading week ahead. This is Lee Lowell signing off.